I know EVs are all the rage in today's market, and if I wanted to grow my YouTube channel, that's probably the topic that I should be talking about. But I'm not really one to follow the norm, and I'd rather put my channel growth to the side to talk about areas that I firmly believe in, ones that I'm educated on, and the areas that I feel really have some great potential for your investment future. So today, I'm going to share with you my 3 favorite real estate stocks. Hey everyone, and thanks for joining me today. My name is Matt, and as I mentioned in the intro, today I am going to share with you my 3 favorite real estate stocks. Of course, as always, before we do that, I just need to say that this is not investment advice. Please don't take it as investment advice. If you do need advice, please go speak to a financial advisor, but please do not make any investment decisions based solely on what you hear. And also, that way, I always like to ask, if you don't mind just sticking around to the end, and if you like the video, hopefully you'll give it a thumbs up then. Subscribing, still free. That's a cool thing to do. Now, that is all the rage I've heard these days is subscribing to my channel. So if you want to hop on board with that, I'd greatly appreciate it. Other than that, don't really have much to say. So let's just go ahead and jump right into this. Now, the first stock that I have for you is one that I'm sure most of you have probably heard of before, even if you're not fully aware of this business. And it's Public Storage. Now, I use stock loosely because this is technically a REIT, but it is traded on the New York Stock Exchange. Public Storage is also the largest self-storage association in the United States, and it has around 2,500 facilities in the US. Public Storage added 400,000 new customers during these first 2 quarters of this year, and also had fewer people moving out of the storage when compared to previous quarters. While I might not be the customer that you'll see for Public Storage, I really enjoy this business model because it's very simple and very straightforward. They buy buildings, they rent out space, they collect the lease payments, and since this is classified as a lease, they pay out a lot of those lease payments back to the shareholders. So it's really simple and a really straightforward business, and one that really doesn't take much of like an in-depth understanding just to understand how important this business could be to the consumer. Another reason why I like PSA is because they really do handle economic downturns well. While I don't believe that any stock is 100% recession proof, PSA has shown in the past that they are able to navigate times of uncertainty very well. And if you're one of those, I think we might be going into maybe a time of an economic downturn. Having something that can handle those uncertain times very well could be beneficial to have in your portfolio, and it just helps keep a little bit more peace of mind knowing that it's not going to be a very volatile investment. Now, for a REIT, PSA has actually been experiencing very good growth numbers. And the reason why I say it that way is because REITs generally are something you invest in for the income. We don't really care as much about the growth. Sure, it should be there in theory because as these properties build equity, then there should be a growth side to it. But generally we go after these for the income that they produce. That said, PSA has shown strong growth. And if you want to look up their chart for the time being, I'll see if I can pop that up on the screen. But it's been very impressive. Again, considering 07, 08, sure they took a downturn, everybody did, but they came out on top and they've been steadily growing since then. And according to some analysts from the Motley Fool, Million Acres, they see that PSA will be even more powerful and prominent in the next 5 years than it is today. So it's something that has a very bright looking future and something that I am considering adding to my own portfolio. But before we do that, we do just need to review these numbers. All right, so as we could see here, and as I mentioned earlier, this is not a volatile investment. This is definitely one for people who prefer slow and steady wins the race or don't like much fluctuation, because this one does have the beta of 0.15, probably one of the lowest betas I've seen from all of the companies that I've looked at. They have a PE of 33.7, which sounds high, but it's actually under the average for storage units or storage facilities. I want to say the average is around 37, so not by much, but it is notable or worth noting that it does have a lower PE ratio than what the average is for the industry. Revenue growth at 2.85%, a little disappointing considering some of their peers were around 8 to 11% range, but with PSA being the largest one, and now they have a focus on basically acquiring other storage facilities as well as building from the ground up, I think that it's safe to see that it's good to see they are growing the revenue growth, but something I wish that we could see a little bit higher of a number for. Dividend yield of 3.39% gets you around $8 a year per share if you own this investment. Now, considering this is trading around $260, no, it's not going to be a get-rich-quick stock, and you're definitely not going to make money quickly off this. But again, the income this produces is a very nice incentive to own on or hold on to this position. Their peers only pay out around $1 to $3 annually, so they have a much higher dividend compared to their peers. And over time, if you're one of those people that are into compounding interest, this could be a very promising position to have in your portfolio if you just keep taking those dividends and reinvesting it either back into this company or other forms of income producing investments. And this quick ratio here. This quick ratio blew my mind because again, their peers were really sitting around like 0.8 to 1.2-ish for the quick ratio, and PSA sitting pretty at 3.2. That's really high for a real estate company, and one that honestly kind of surprised me to see, because it's not like building these facilities are cheap. And it's going to be a very expensive process considering they're climate controlled, they have, security access, they have to have somebody on board at all times, and for those reasons, I thought it would be much lower, but hey, I will take this pleasant surprise for a company like PSA. The next real estate stock that I have is Homebuilder, and that's going to be D.R. Horton. Now, D.R. Horton isn't as big of a company as PSA, but some of you may have heard them before, again, given that they are the largest home builder in the US. They operate under 4 branches, and this is the part that I really like about D.R. Horton compared to some of the other home builders, because their 4 branches that they have are really tailored towards different buyers. So they have one branch that focuses on entry-level buyers, they have another branch that focuses on luxury buildings, they have another that focuses even on retirement communities. So the areas that they're focused on are the ones that are the areas that everybody's going to be buying into anyway. And that's something that I like, because I think that looking into something like a luxury home builder only could be very risky, because luxury homes aren't built as often as entry-level or even mid-level homes are. And so seeing that D.R. Horton is able to spread that is a great thing to see. Also, too, retirement communities are becoming more and more popular these days. So good to see as well that they have a focus on those retirement communities, just adding towards the ways that they can generate revenue. D.R. Horton also has a model though that I like, where they build the homes as they're purchased. They do build a few ahead of time, but for the most part they build their homes after somebody said, this is the one I want, sign the contract, all of that stuff. Compared to somebody like, I believe Lennar is a company that just builds entire communities before anybody even purchased one of the lots, and then just fill the inventory from there, basically making it more move-in ready as opposed to waiting for the home to be built. I like D.R. Horton's approach better though, because it's better risk management in my opinion, to build as they're bought, not buy and then not build and wait for you to buy, if that makes sense. Now, I know it seems a little crazy buying into a home building stock right now, considering what happened in 2008, and I'm sure a lot of people have questions about that. But as I've said before, I really don't think, if we were to head into a recession right now, I don't think it would be similar to what happened in 2008 by any means. I think it would actually be much different. And if I had to, just for a point of reference, kind of pinpoint another recession that it'd be more like, I personally believe that if we were to go into a recession right now, it'd be more similar to the dot-com bubble, and I don't think housing will be as affected as it was in 2008, considering that recession was truly built off of homes. Just a few other quick reasons why I really like D.R. Horton though is, as we've all seen, a lot of people are fleeing major cities and looking to move more towards the suburbs. And with that, suburbs only have so much inventory, so there's going to have to continue to add homes, which means new homes should become more and more popular. But now let's go ahead and look at some of these numbers here for D.R. Horton. So much more volatile than what we saw for PSA, coming in at 1.67. Not too bad, but it is a little bit more risky than what I typically invest in. But again, one that shows some promise to it, and if you can stomach the volatility, then this could be something worth looking at towards adding towards your portfolio. I did not word that correctly. A PE of 11.99. Now, yeah, that seems very low, but this area's average is around 14.4-ish for the PE ratio, or 14 times earnings. So Undervalued, yes, not significantly, but much better to see than completely overvalued like Tesla at 1100 PE ratio. Revenue growth, much better than PSA. We have 11.08 for the year-over-year revenue growth. Again, something I like to see because it shows, buying a home or for home builders is really a one-off transaction. So they sell it and they're done with it. So to see that, and there's only so much land. So to see that they're able to continue to grow their revenue either means that they are expanding into new areas and growing as a business, or they've become more efficient with their operations and have found ways that they don't have to pay as much per home built. A little bit of a lower dividend yield, but I think when I look at DR Horton, it's more of a growth story than it is an income story. So the dividend yield, as I've said before, it's just kind of an incentive or an added bonus for owning this stock. But this is one personally, given the beta as well, that I would invest in more for the growth and the income. Because after you invest in this company, it's only going to make you around 70 cents a year. So nothing, again, that'll make you rich quick, but nice to have in the portfolio because who doesn't like money? And a quick ratio, 0.8. It makes sense. I honestly thought they would be more of like a 1.2er when it comes to their quick ratio. They do have a current ratio that's over 1. I think it's actually around 2 or 3. But we're sticking with the quick ratio here. And it does make sense because there is an upfront cost when DR Horton builds these homes. Because if you look at a neighborhood that's a DR Horton builder, actually my neighborhood is, we have a model home. And they don't make money off that model home. That model home is going to sit there until they've sold all of the lots, and then they basically reconstruct that home to be more home-like, and then they sell that one. So there is a pretty expensive upfront capital cost when it comes to building these neighborhoods. I think they even have to buy out the land. So it's not cheap, and it makes sense for them to have a quick ratio that's under 1 and really not one that I'm too concerned about. And lastly, this one might take most of you by surprise here because it's not a direct real estate play, but it's Lowe's and Home Depot. Now, reason why I have 2 listed here underneath really the same category is Lowe's and Home Depot is kind of like Coke and Pepsi. Really just pick and choose which years you want to look at to see which one's the better performer. I have done a full in-depth analysis on my watch list Wednesday for Home Depot. I think it was like the 3rd company I did. And since then, the reason why I chose Home Depot over Lowe's was because Home Depot had a tool rental program. Well, now Lowe's does as well. And really, there's now not much of a big difference between Lowe's and Home Depot, for me at least, when it comes from the investment side without redoing that entire analysis. So really pick and choose which one you'd rather own, or as I've said before, nothing wrong with owning both. But how does this tie into real estate? So I have an example here, and think of it like a car. You buy a car, all of a sudden your car needs new brake pads. You don't go out and buy a new car because you ran out of gas, your tire popped, or you need new brake pads. You replace those parts. So same thing in your house. When your light bulb goes out or when your garbage disposal stops working, that doesn't mean you go out and buy a new house. You go to Lowe's or Home Depot and get what you need to fix the problem. And so while this isn't buying land or it's not receiving rent payments or anything along those lines, home improvement is a huge part of real estate. And so I truly look at Lowe's and Home Depot both as an indirect real estate play. And honestly, if you were to head into an economic downturn situation, then that's where these companies really start to shine, because people aren't buying and selling as much real estate, rather just fixing and working on what they already own. So that's why I like these as a real estate investment. And let's take a look at their numbers real quickly. Just again, I've already talked about these companies before, so nothing to really keep going on and on about. So as we can see here, Lowe's is a little bit more volatile than Home Depot, not by much. And I guess with that little bit more volatility, you could see Lowe's has a little bit more favorable of a PE ratio. These are both still lower than the average, but remember that this is retail, so it's a little bit different of a category. And I want to say that the average is only like 25, so not much lower for a PE ratio than what the industry average is. Both have impressive revenue growth. Lowe's is doing a little bit better with their revenue growth, and I believe maybe part of that could be with their tool rental program. I know they've done a bunch of other things. I know that their current CEO has only been in for around 2 years or so. And I apologize, I forget what his name is, but I know that he's done a really good job of taking this company in the right direction. So great to see that revenue growth for Lowe's, and same for Home Depot as well. 8.46% for such a well-established company is still something I enjoy seeing. Dividend yield 2.17, 1.43. I think that was the other reason why I chose Home Depot, is because they pay the better dividend compared to Lowe's. But that's ultimately up to you again if you're more into the growth story or the income story. Annual dividends 5.86 or $5.86 and $2.25. That is a pretty big difference between the two of them, but I think Home Depot trades around $100 more a share than Lowe's is. So again, pick and choose your battles. Can you use that extra $100 in Lowe's to help boost up that dividend yield? Current ratios, these are both sitting around the same area, 0.69 and 0.6. Which I was a little confused about, because again, these are pretty well established companies. So I was just a little taken back by the fact that neither of them have the quick ratio over 1. But again, these companies have very strong roots and they've been around for such a long time that, really these ratios come into play when these companies need to raise money. And, should Lowe's or Home Depot need to raise money, I don't think many people would say, oh, no, you're too risky for us. We cannot loan you any money. So those are the 3 real estate stocks that I really like. But that's not all of them. There's a 4th. But unfortunately, you will have to stick around for tomorrow's Watch List Wednesday to see what that 4th company is. But I hope you enjoyed this video. Again, I know everybody's out there talking about EVs. You might be getting a little tired of it. I know it just seems like any time I try to find something to talk about, it's only electric vehicles. And I like talking about all the other industries as well. So this hopefully will add just a little bit of variety to your day today, and learn a little bit about real estate and why I think Lowe's and Home Depot is actually a real estate investment. So thanks for watching. If you like this video, made it this far, hope you consider hitting that thumbs up button. And if you haven't already, I just ask that you please subscribe. It's like 90% of you haven't subscribed. I lost like 4 subscribers this past week. So if you don't mind sticking around for a while, and it just helps me out so much. But with all that said, I'm going to stop here because I have some research to do for tomorrow's video. Thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world, but you're right here with me, and I really appreciate that. I'll let you go ahead, enjoy the rest of your day, and I will see you next time.